Today, in under 20 minutes, I will tell you what you need to know if you want to invest in Adobe. Trading near $357 per share, I currently have a buy rating on Adobe, but there are several key factors that have a major impact on this thesis that I'll go deeper on. I will give you the positives and negatives from the 3Q results, a breakdown of the three financial statements and my Wall Street valuation model, what other analysts on Wall Street say about Adobe, and my conclusion on Adobe's future and what you should do. So why should you listen to me? My name is Ken Freeman. I'm a CFA charter holder. I'm also a professor of finance and economics. I have 20 years of Wall Street experience, and I'm the guy that investment banks like JP Morgan and asset managers like BlackRock hire to train their financial analysts on Wall Street. In my research, I discovered 6 things that got me very excited and 6 red flags to watch out for with Adobe. If you're enjoying this, please smash that like button. Adobe beat Wall Street estimates on revenues and earnings, and they increased guidance. Let's cover the red flags first. Adobe set its goal for profit margins very high, so there's little room for error. Even a small change in spending or pricing could push results below what investors expect.
You've got world-class companies like Canva and Figma coming right at them. You've got AI and generative powers that are completely transforming what these apps can do. Better, faster, cheaper, more dynamic products. And I think Adobe's starting to feel that pressure.
Only 2/3 of signed contracts will be billed in this year, so part of Adobe's backlog is further out. If customers delay or cancel projects, near-term growth can slow.
I'll also be looking at digital media annualized recurring revenue. That is the predictable sales that they get from subscribers of Creative Cloud, and it gives us a read of customer retention and spending power. Adobe, remember, hiked prices as much as 17% on some plans in the quarter, which should help lift revenue, but there's also concern that some users might cancel instead of paying more.
Annual recurring revenue, ARR, shows how much customers pay on subscriptions each year, not what's recorded as sales. This number can look strong even when cash collection or reported revenue lags.
We exited the quarter with $18.09 billion of digital media ARR, growing ending ARR 12.1% year over year.
The company warns that problems with its AI tools could bring lawsuits or new compliance costs. Governments are passing AI laws that could limit how Adobe uses its own technology.
Adobe's very much under attack. They've been one of the incumbents. They went through cloud transition 1 very admirably, went from the on-prem and the downloadable move to cloud. They're facing this next horizon of cloud challenge with AI, and I think it's going to be much harder for them to navigate.
Management's own statements names AI issues, system outages, and cyber attacks as ongoing worries. The market is not confident that Adobe can compete in the new AI landscape, and this is why the stock is down.
They've got this existential extinction level event coming at them, and they've got to react. And if they can't do this organically, you see folks like Meta that are paying unlimited packages to try to bring in talent to do it. But folks like the Adobes and the Oracles of the world, they need to respond in different ways. I think that they're going to start doing aggressive deals, and they're going to start buying companies that can be both defensive blockers in key areas and build it up.
Some investors are losing patience and heading for the exits. In the last year, the stock is down 35%, and it lags the S&P 500 by 50%. Despite this, analysts say that Adobe's fair value should be much higher. So, when will the stock recover? Investing is not for the faint of heart. Fundamental analysis works over the long run, but it can test your patience in the short run.
We're all looking for the short-term print tonight, which may show a little bit of it, but it's really the longer-term strategic piece here that's going to be much more telling, and I think we're starting to see those cracks.
Here's what got me really excited. Adobe's generative AI tools are being used commercially, not just tested, proving a real market fit. That helps expand paid subscriptions and boost cross-selling into Creative Cloud.
Excitement for and adoption of generative AI innovation, such as generative fill in Photoshop, generative remove in Lightroom, generative expand in Illustrator, generative extend in Premiere Pro, video generation in the Firefly app, and production workflows in Firefly services continues to accelerate, with over 24 billion cumulative generations exiting Q2.
Recurring subscriptions mean steady cash flow, even if new sales slow down. Predictable ARR helps Adobe invest through downturns without cutting growth plans.
We've got a Q3 ARR for the digital media business. This includes its Creative Cloud subscriptions that came in at $18.59 billion during the period. That is above the consensus of $18.56 billion.
Adobe generates more cash relative to its stock price than most large tech peers, giving it flexibility for buybacks and reinvestment. A 6.6% free cash flow yield shows that even after a tough year, Adobe keeps its business growing and throwing off serious cash. Large organizations are using Adobe's PDF and e-signature tools more broadly, giving the company another long-term growth foothold. This part of the business is less volatile than creative software and benefits from corporate renewals.
That a 6% bump up coming after a beat across the board. We've got adjusted EPS of $5.31. $5.18 is what the street had been looking for. On revenue, coming in at $5.99 billion versus $5.91 billion expected.
Adobe owns one of the world's richest creative datasets, legally sourced and enterprise-ready to power Firefly. That gives it a moat against AI rivals who rely on scraped or unlicensed data.
We have trained our Firefly models, as many of you know, on stock and other content that we have access to. We do have a contributor fund that pays out to those individuals. And as a result, we feel like we're in a very advantaged position when it comes to people choosing models. I'll say, especially in enterprises, we see a lot of companies selecting Firefly, partially because of the quality, partially because of the controllability of it, but also very, very strongly because of the commercial safety of it.
This is what everyone is missing. Adobe's ongoing repurchase plan shows that management still believes the stock is undervalued. Aggressive repurchases when the stock is down reduces share count and boosts value for shareholders.
In Q2, we entered into a share repurchase agreement totaling $3.50 billion, and we currently have $10.90 billion remaining of our $25 billion authorization granted in March 2024.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
Not interested.
That is exactly what you're doing when you buy a stock without understanding the 3 financial statements. If you want to see how I teach the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. Despite spending billions buying back shares, Adobe has nearly $6 billion of cash and short-term investments. Also, their leverage is very low with a debt to EBITDA of less than 1. Debt is under control, and with a big pile of cash, it gives the company a war chest to deploy on AI investments or return capital to shareholders. Because Adobe has no physical inventory, we look at their working capital management by comparing receivables to payables. While rarely seen, Adobe has a negative cash conversion cycle. They are receiving money from customers 3 weeks before paying to suppliers, which gives the company incredible financial flexibility. Because the company generates consistent and growing net income without paying a dividend, retained earnings is growing substantially. Increasing retained earnings indicates that the core equity of the company is growing, which is a great sign for investors. So what's the takeaway? Billions of cash with debt under control, world-class working capital management, and growing retained earnings give us a rock-solid balance sheet for Adobe. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Revenue is solid, stable, and growing substantially. Revenue growth has averaged over 14% over the last 5 years. 96% of Adobe's revenue is subscription-based, which is the stickiest and most predictable. Gross margin above 90% is unheard of, even in the tech space. Adobe's gross margin is comparable to Meta. High margins indicate more profitability. Over the last 2 years, interest income has exceeded interest expense. This means that Adobe is making more on its invested cash than it pays on its debt. So they can pay interest without impacting their core business. So what's the takeaway? Revenue growth in the low double digits, nearly all of which is subscription-based with high and expanding margins, show that Adobe is profitable and growing. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally. Investing, which is the cash demanded for long-term growth. Financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow is positive and growing rapidly. This is primarily driven by the strong net income that Adobe is generating. Because it is a software company, this is a low CapEx business. Over the last 5 years, CapEx has averaged only 2% of sales. This has resulted in large and growing free cash flow, which is the basis for our valuation. Over the last 5 years, Adobe has returned $27.5 billion to shareholders. The board authorized $25 billion in March of 2024, and there's $8.4 billion remaining. This means that the company can continue repurchasing shares when the stock is down, which reduces share count and boosts value for shareholders. So what's the takeaway? Robust free cash flow, low capex, and billions being returned to shareholders. All positives that investors love to see. So what do I think about Adobe and what should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get the total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of $192.8 billion. We divide by the current shares outstanding. We get an implied share price of $460.48 compared to the current close of $357.55. That's a 28.8% discount, which is a screaming buy rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides us a margin of safety. I'll give you my thoughts on how to play Adobe later in the video. So what does Wall Street have to say about Adobe? Let's cover that next.
Hello, Wall Street.
Wall Street consensus has Adobe as a buy, but the biggest question is around how the company is going to leverage AI amid steep competition. Evercore maintains an outperform rating and cut its target to 450 from 475. They argue that franchise strength and a higher full-year outlook offset a slower than hoped AI ramp. Barclays has a buy rating, and they raised their price target to 465 from 460 after Q3, with net new ARR beating and AI-first ARR hitting the 250 million full-year target early, reinforcing the AI path. JP Morgan has a buy rating with a price target of 540. They see solid execution and revenue momentum post Q3, maintaining a constructive view as Adobe nudged full-year 25 guidance higher and highlighted growing AI-influenced ARR. CapIQ gives me a sense of how other analysts on Wall Street view the company. 35 analysts cover Adobe on Wall Street. The target price ranges from a low of 280, which is a 22% decrease, to a high of 605, which is a 69% increase. Upside outweighs downside by 3.1x. Hedge funds typically look for 2 times and above. The median is 460, which is a 29% increase. The overall rating on a scale of 1 to 5 is 2.03, which is an outperform rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I am building a position in Adobe as a result of this analysis. It is currently 1.6% of my overall portfolio and my smallest position. If you decide to buy Adobe and become a shareholder like me, I'll tell you exactly how to build a position, which I'll reveal shortly. Adobe's global footprint spreads risk across markets, reducing dependence on any one region. Revenue is growing worldwide, and about 40% are outside of the Americas. This cushions performance if North American tech budgets tighten. Adobe just launched AI Foundry, letting companies build their own brand-specific generative AI models using their private media libraries. This gives Adobe a clear edge selling to large corporate customers who need IP-sourced AI solutions. Once teams build their entire creative process around Adobe's tools, leaving is painful and expensive. That means that revenue is sticky. Enterprise clients rarely churn because replacing Adobe would break their workflow. Adobe hit a 52-week low of $327.50 in mid-October 2025, and it's up over 9% since then. My model shows a value of $460.48, which is a 28.8% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Adobe is a solid buy at current levels. And if you decide to add it to your portfolio, this is what you should do. Decide how much capital you want to allocate to the position. I typically choose 10% as my max, but start small and build over time. Utilize limit buy orders so that you're not chasing the stock. Break your purchases into pieces so that you dollar cost average into the position. Adobe has a world-class brand. 96% of its revenue is subscription-based and gross margin is above 90%. Despite the stock being down about 27.5% in the last year, this presents a great opportunity for patient investors. While the market has punished Adobe for not having a comprehensive AI strategy, I feel that its brand, product offering, high margins, and sticky customers present a compelling compelling opportunity. If you like this and want to see another in-depth stock valuation, check out my Constellation Brands video here or my Meta video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.